When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what this week's economic news means for retirees. We'll also answer listener questions and finally what happened in the markets during the second quarter of 2026 and what should investors do now. My name's Jeff Shade. As always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic now that the 4th of July is behind us and the second half of the year is laid out in front of us here. Jeff, every day we're bombarded with headlines about inflation, interest rates, jobs, the stock market, and the economy. And most retirees wonder, how does any of this affect me? Well, today we're going to sort through the noise and explain what really matters for people who are retired or preparing for retirement. Biggest economic story this week has been the June jobs report, Jeff. Hiring came in much weaker than expected. Why is Wall Street so focused on just one employment report?
Well, I think it's weird that they're focused on just a month-to-month report. It should be kind of a trend that they're looking at. And June is typically a low hiring month anyway because it's summertime and a lot of businesses aren't looking to expand. I mean, bosses and anybody in management's trying to go on vacation and spend their money and hang out with their families and do fun stuff. So, yeah, it's kind of a slow time for economic growth anyway. Typically, if you look at history, the stock market hasn't really done that well in the summertime, except, I guess, the last few years. I mean, we've seen July's and August being pretty strong in the market, but on lighter volume than normal as well. But there still has to be enough hype to keep the market going and keep the buzz on Wall Street pulling in new money to keep the market going up. And they like good numbers to support the economic story that the economy's growing like crazy. And honestly, it isn't. GDP's not growing at a fast enough clip. I mean, we've got a ton of, just barely keeping up with just the increase in population and birth rate in America, let alone just really keeping up with what's supposedly the big future earnings of these companies in the AI business and energy and other things that are supporting that. But the June jobs report, they always have to have something to talk about. So anything that's reporting an economic number typically will sway the market. And a lot of times the market makers, in other words, the inventory holders, the big institutions, the pension funds, the big banks, the Merrill Lynch's and the JP Morgan's of the world that own basically the biggest inventories of stock, typically use these reports as either a way to get more people excited to send more money to go into the market and buy their stock so that they can take profits, or they like bad numbers that kind of scare the market so that people that are maybe a little bit less sophisticated and aren't in it for the long haul, especially day traders or short-term traders, will bail out of the stock to give them an opportunity to buy cheaper. And so many times, just what is made of these reports, there's really more of a manipulative story by the market makers, by Wall Street, not really any indicator of what the long-term benefit of holding Apple stock would be or Micron or other things. So again, if you're a long-term investor, you don't really care if the market's going up or down. If you're a short-term investor, meaning you're taking income and things like that, you need to be a little bit more wise to how these reports might affect the market. They affect the market based on how the market, or let's say the Wall Street and how the news, their talking heads basically report it as being weak as a bad thing or weak as a good thing. The hiring report is low. In my opinion, that would say, well, good. Companies aren't overspending on employees and using up their profits that could be making my stock increase its value. Instead, they're using the profits either to maybe do more R&D or maybe just do more marketing and things like that that might enhance sales and increase revenues without increasing expenses. So a low jobs report doesn't necessarily mean anything for the companies that I invest in. Maybe it's actually a good thing. We see companies' stock prices zoom as soon as they announce a 10,000 employee layoff like Amazon does every now and then. And they go, oh, good. Well, look at all the money they're going to save. That's going to go to the bottom line and the stock should go up. And many times it does. But then the idea that If companies aren't hiring, does that mean that they're not expecting earnings to come in? Well, let's look at the season. It's June. Is that really the season that people are jumping into manufacturing or jumping into growing their businesses? Maybe June. It's too late to really get the hospitality industry jobs. They're probably hired in April or May, when school gets out, or just right before school gets out. June, things are already rolling by now. People aren't probably taking on new jobs. They're on vacation, so they're not taking on new projects, company projects. We'll see that happen in the fall. The end of the year is typically when we see some of that growth, if we don't see a nice little crash first. I mean, September and October are definitely months that are historically known for corrections. That might be after a summer off and companies come back and realize, well, things aren't really ready to get back on the roll, or people just say, hey, we've had a good summer. Let's just take some profits and try to do some reevaluating of our investments before the end of the year. Again, I don't know that it means anything other than how it's interpreted and what the market does. We just look at volumes when these reports come in and see if the buying is increasing in certain sectors or selling in certain sectors. We've seen huge buying in the tech sector the last few months, but we've seen huge selling in it just the last few weeks or so. And with this report, we're still seeing it, like Micron, just name one stock that was driving the market. I mean, up hundreds of percent in just the last year because of all the memory chips and all the demand and the fact that they can raise prices and do all these things. That's thinking stocks topped out around 1250, I think it was, and then it's in the low nines now. So it's down almost 30% from where it was. Some of the people are still buying tech stocks because they think, oh my gosh, they're going to the moon. But we also realize that sometimes they get overbought and they correct pretty harsh in a very short period of time. So if you started buying Micron when it hit 1,000, thinking that was your lucky number, you're down at least 10% if you didn't pay more than 1,000, a little over 1,000 for it. So we have to be careful. The market is still trending up, but it's a different set of stocks that seem to be affecting the market indexes at any given time. And I think eventually they're all going to run out of gas. It's kind of weird that tech got, especially the semiconductor industry and memories, chips and things like that, got so overblown and overvalued. And that's what basically caused the recovery of the market that was down over 10%. All the indexes were down over 10% the first part of the year. And then they just dialed in on certain sectors of the market. The tech sector, semiconductor especially, started going up. Now we're seeing a little bit of rotation into the consumers. They're kind of solid. We're seeing some of the pharmaceuticals and healthcare stocks doing better now. So again, there's always some sort of a rotation into the market. The money always moves. We just watch where it's moving to as far as how we do our investing. But you got to be on top of it on a day-to-day basis as fast as this market is moving, as fast as the whims of the market are changing. So it's a choppy market. It's a pretty overvalued market, a very overvalued market. And it's not for the faint of heart, those people that want to trade or invest in it right now, unless you've just got blinders on and can hold long term. I'm talking decades, because we're probably going to have some corrections along the way because the market is so overvalued. But again, the June jobs report is just one little thing. It may affect the market. It may actually cause a sell-off in certain sectors. And if it does, we might see a domino effect. One of the things that I see in the market, I know I'm elaborating on a lot of subjects more than just the report and how one report affects the market, but the fact is the market is affected by different things. And these little economic reports, if you get a bad report or one is interpreted badly and there starts becoming a sell-off, the biggest thing I'm worried about is margin calls. There's record amounts, trillions of dollars in margin, meaning people are borrowing money to buy more stock, even at overinflated values, which is actually overinflating the values even more, exacerbating the issue. But the problem is if the stock goes down, the companies will sell the stock in order to raise the money to pay off the money you borrowed to buy the stock in the first place. And they will actually forces the price of those stocks down. Now, institutions who do that, they sit on big wads of cash and they're just waiting for those margin calls to kick in, because they're going to sell your stock at a gain. They're going to keep the money, get their money back, and then they're going to basically buy low when the market ends up correcting. So the market's always in charge. The market always wins. And we're just kind of the pawns in the game. And we hope we're on the right square when the moves take place. And we're not the ones that are getting hit by the correction when it happens. So again, that's why we use principal protected assets. We use a diversified portfolio of things that are not market risk oriented, and stay out of the way of all that.
We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management right here in Tucson. We're talking about what this week's economic news means for retirees. Again, if you'd like to come and sit down with Jeff and talk about your own individual situation, how these things may affect you, we're offering our Premier Retirement Roadmap. Absolutely no cost and no obligation. To get yours, call 520-780-9059. It's 520-780-9059. Now, you can make the call today if you want. Leave your name and telephone number, and Shelley will call you back during the week and set up that appointment for you. It's just a casual conversation. No cost, no obligation. 520-780-9059 is the number. Jeff, inflation has certainly dominated the news for the past couple of years here. Are we finally turning the corner, do you think?
Well, I thought we were turning the corner for a while, and then we had this war in Iran, which is still going on longer than expected, and oil prices have been pretty sticky the last few months. And they've come down a little bit, I think, because they're not continuing to grow, but we've kind of got some sort of stability in the oil market because a lot of the local producers of oil are starting to drill the wells again, uncap some of the wells, and so we got a lot more domestic production to help. But oil is a big driver of the cost of everything. I mean, it really comes down to transportation costs. Some of the biggest costs of anything you buy at the store is how much it costs to get the tomato or the head of cabbage there, not just what it costs to grow it and the water it took to grow it and take it out of the ground. It's the transportation cost that matters. So prices on certain things could even double or triple just based on the fact that gas doubles or triples in cost. So again, inflation is a problem. It's kind of reared its ugly head again lately. I hope it doesn't continue to go because inflation does two things. One is, well, inflation typically causes more pressure on the Fed to keep interest rates high in order to curb inflation, because the lower the interest rate, the more activity we have with money, the more people are willing to spend more for things, and it doesn't create pressure to keep those prices affordable for basically the working class, the middle class, probably more than half of our country's citizens. So, in order to keep things in check, we've got to keep inflation more in check. And the goal used to be 2%, but now it seems to be under 3. If it starts with a 2, it's okay, even if it's 2.9 or somewhere close to 3. But it doesn't look like it's down below 3 lately. And it looks like it's still kind of trending up or kind of sticking in that 4-ish range, maybe even a little bit higher than that. So hopefully we can get inflation under control. The problem is with inflation is it does eat up typically a little bit more of, if the inflation is affecting, and typically it does, unfortunately, food and things like that are the staples of life, and everybody has to buy those things. I mean, they can wait on the couch or the new car and things like that sometimes if budget doesn't handle it, but everybody needs food, utilities, gas, transportation, things like that. So because it affects the everyday purchases, it may cause somebody to have to ratchet up their withdrawals. And we've had a few clients just recently call in and say, hey, man, I need another $500 a month. Things are a little tight. So can I take more out of my investment accounts? Well, you can. Problem with inflation is typically inflation has a negative effect on the market because costs go up, consumer costs go up, but also producer costs go up. And if producer costs go up, that exacerbates the problem and makes the cost of goods go up, the cost of transportation, those goods are going up. And then the inflation is continually cycling upwards and trending up. So with that, it creates less profits for companies, or if it does create more profits for companies because they continue to raise their prices accordingly, then it creates a bigger squeeze economically for the people that buy those products. So it typically will hurt the market. We remember in 2022 when the market was getting hammered, when Biden was kind of losing track of inflation and monetary supply, started printing money like crazy to kind of get us out of the COVID problem and do it in a very economically unfriendly way. Now, granted, I think we were very due and very much needed a correction in the stock market. I think it only half done before they started printing money again and creating more monetary supply, which really just helped the rich get richer. And those people that had stock and bonds continue to get richer, not necessarily bonds, but stocks. And we're still seeing that where the wealthy people that have investments are continuing to invest and they don't really care about inflation. In fact, the wealthy people like inflation because all their stuff that they've invested in, their hard assets like real estate, art, collectibles, things like that go up in value rather than stagnate. Also, interest rates going up doesn't really hurt the saver that likes CDs and other super safe investments because now they get a little bit better return. Problem is if you get 4 or 5% on your bond, but the inflation is 4 or 5%, you're still just barely breaking even. If you're getting 3 or 4% on your bonds and CDs, but inflation is back down around 2, then you're at least getting ahead a little bit and able to keep ahead of the curve. So inflation is a problem, not just because things cost more and you have to burn through your savings more, but also because it typically, not lately, not the last couple of years, but even the last few months, it doesn't seem to be affecting it too much. But eventually, I think the inflation story will hit the market, make it weaker, and make it harder to keep up with inflation. And that's kind of an interesting misunderstanding is because, inflation's high, I got to make more in the market. Well, when inflation's high, the market typically doesn't overperform. So good luck with that. Typically, it's the inflationary periods where the market really stinks. You're never going to keep up with inflation with those investments. It's when the market is zooming, usually is when the inflation is under control. That's when we put away money and basically store those assets for the future when those inflationary times come. And that's probably one of the hardest things I have to teach people is, yeah, well, I'm okay making 2% while inflation's only 2%. I don't really need to be invested in the market or have any upside because I'm doing fine. Well, wait till the market's not doing well and because inflation's up at 4 or 5% and you only made 2 or 3% on your money and spent all of it plus a little bit of your principal to get by. Now you're in worse shape to weather the storm of that inflationary period. So again, that's why we talk about balance. We talk about different buckets of money, the safe stuff, the tax preferred accounts, the tax favorable distributions for income, making sure that there's a place where you can grow money that offsets what you might deplete out of those other safe accounts in income. So that when those extra expenses come or those uncertain expenses come, if prices happen to be higher than they are now, then you're able to afford those things like the new air conditioner or the trip to see the kids when they have a baby in Florida or whatever, that you're prepared to handle those extras. And honestly, that's really comes back to why we have a plan. We have a plan that takes into consideration the inflationary pressures that might happen, those that we know are happening, making sure you have income, making sure you have some sort of inflationary protection as you grow older. Not because you're necessarily going to do more fun things and spend more and more as you age, but certain things, just like food and utilities and things that you need, are going to go up, and they may not be covered merely by the cost of living adjustment on your Social Security account. We have to build that into your plan.
Jeff, as far as inflation goes, while you were talking there, I took a look at what it was currently, 4.2% compared to 3.8% last month, 2.4% last year, so we're almost doubled year over year. Jeff, despite concerns about slower growth, the stock market didn't drop. It had just basically another fair week.
It did. A fair week, it's kind of leveling out a little bit. The thing is, everybody thinks the market's just screaming along because they announce a new high here and there. The Dow's actually done okay, but that's only 30 stocks. They're kind of handpicked, and they tend to get kind of overplayed by the institutions in order to make the indexes look good so they can sucker us into continuing to put more money in it. But I think we're seeing kind of a topping out or a flattening out period in the market right now. For the last 6 weeks or so, it's been pretty flat. The NASDAQ actually for the last 6 weeks is down. If you look at the last month on the NASDAQ, it's still down for the month. It was 1/10 of a point from a week ago from right now. It's just kind of meandering along. And every time it has a good day, we hear about the good days and we think, oh my gosh, the market's just screaming to the moon. But, if we remember that in the beginning of the year, the market was down over 10%. And then somehow semiconductors got hot. It just boomed like 20. So now the year-to-date ups are kind of in that 8 or 10% range for the year. But the way the news puts it, it looks like, wow, the market's making all-time highs, new highs, and it's going to the moon. And everybody's, I even heard Trump say, yeah, well, look at your 401k. It's up 86% so far this year. Why are you worried about how much money I'm making in crypto? Like, I don't know anybody's 401k up 86%. In fact, I don't even see 401ks up 10% year to date very often. I don't think I have in a long, long time that beat the market indexes. And the market indexes, again, are very thinly traded, meaning there's a very small number of stocks that have actually contributed to the stock market's gain. And it's interesting if you look at, the Magnificent Seven, Tesla, Amazon, Apple, Microsoft, Meta, Google, those big fat stocks that drove the market a year ago and did everything for the indexes. If you look at the year to date on the Mag 7, they're not even beating Warren Buffett. They're less than 2% up. And that's only because they had a good week. If we look at the last month, the Magnificent Seven are down. If you look at the last month and a half-ish, like I said, they're just flat at best. Look at from a year ago, they certainly haven't kept up with the market. And most of the gains, if we look at back in, we're lower than we were in November of 2025. So for 8 months, those Magnificent Seven stocks as a whole are losing money. And so if you don't know when to get out of those blue chips that drove the market and how to get into those little newcomers that aren't even in the Magnificent Seven, but somehow as a group, like the semiconductors or some of the energy AI-driven stocks have been pushing the indexes up. So again, either you ride the market and just hope there's enough portion of some sector in the market that'll overcome what used to be driven by those big solid names, the Apple, Amazons, Metas, and Googles, which aren't driving the market anymore. One is here and there, but by and large, they're mostly downtrending for the last several months. So where do you find the gains? Well, you either just close your eyes and ride the market and hope down the road it's up, or you try to follow the money and follow those sectors. And it's becoming increasingly difficult to do. But thankfully, when you've got institutions that can play the game to make the indexes look good, and they're doing that, they're doing a good job of that, mostly marketing, it appears that the market may be doing a little bit better than I think overall that it is. I see portfolios coming in all day long, and it's amazing that it's really hard to see a portfolio that's even coming close to what the market indexes are doing, because most portfolios aren't just a market index. Now, if you are in the index, you're probably happy right now, but If you were in the index last year, you would have been much happier being with us looking at the sectors, and we would have doubled those returns. And the year before that also beat it. So you can either be an active manager beating the market, or you can just be satisfied riding it up and down. And right now, hey, you're not unhappy. Shoot, you've made a decent year so far in the first 6 months of the year. But like I said, it looks like it's flattening out a little bit. A lot of the smart money is raising cash. We still see Warren Buffett increasing from 30% cash from a year ago to about 40% now. He's waiting for the big bust so he can buy cheap. And most big managers are. Ray Dalio, the Bridgewater Financial, I believe that's the biggest hedge fund on the planet, is also raising cash. I've heard not too long ago that Druckenmiller, he was George Soros' advisor years ago, and now he's his own self-made billionaire. These guys are all raising cash, and they're not stupid. So we're kind of seeing where smart money realizes that this overvaluation of the market is just going on too long. And I have to look at that. And I think everybody should be looking at that and not just saying, oh, the news, Kramer says buy this and the market just made a new high. What does that mean? Your stock portfolio is making a new high? Right now, probably not. It's been very few and far between that I've seen good returns on portfolios out there when people bring in for reviews. Our portfolios are pretty flat to just a teeny bit up. They're not really kicking the butts in the market. I'm willing to admit that. The market's a little bit hard to read, and we're taking some cautious action to not be too crazy about the upside and be more in a protective mode, because we don't want to lose money if the market starts selling off hard. So again, you got to be really careful with that. Over time, we're still doing just fine. And I think managing the money in this market, if you're managing your own, you're probably having a tough time finding the right stocks to buy, because the right stock to buy changes every day. Like I said, a month ago, Micron was on a roll. It was making 10% a week or more, sometimes 100% in less than a month. But now it's down 30% a month. So the stock market's a double-edged sword, and you got to be careful with it. We're at a time when you've got the hiring numbers are kind of low. The economy isn't really growing as a robust level. We've got smart money raising cash. We've got the market seemingly making new highs and setting records. And we've got a lot of people pumping the market and cheerleading the market. But in reality, the market's been a little bit tough for most people, at least year to date, even though the market's bounced a little bit.
Jeff, as we head into another week, what are the biggest things that retirees should keep an eye on?
Well, I mean, obviously, anything the Fed says kind of dictates what might happen in the market. I think if you have a plan, you shouldn't worry about anything. I don't think retirees should worry about too much. That's why I said that they should get an advisor that can take the worry off your shoulders. Now, as an advisor, I don't want to worry about your money either. I want to manage it. I want to be very conscious of what's going on with it. But if you have a plan where every month you know you're getting more in your bank account guaranteed for life than you need to spend, then it really doesn't matter if these reports tip the market up one way or down. If you've got an active money manager watching your assets, moving out of harm's way when they see these things, then you should put it on their shoulders. And that's what we do. So, and that's what a good advisor would do. If you're just saying, well, let's just put it in the market over time, it averages X and I should be okay, and somebody's taking a fee for that so they can golf every day and not actually watch your money, then you're paying for less than adequate services, in my opinion. They should be adding tax planning like we do. They should be adding income planning like we do. They should be adding reviews regarding whether or not you're going to hit your IRMA, the extra tax you pay on your Medicare benefits, when to take Social Security. All those things should be included for the fees that you pay an advisor. We do that. We're comprehensive. And we only do that on the part of the money that we actually charge fees to manage. Typically, a half to 2/3 of people's money are set up with principal protected assets that either generate tax advantage cash flow or guaranteed cash flow, income that you can't outlive regardless, so that you have the peace of mind to not worry about what happens on these next Fed reports or so forth. But, if you are watching your own money, if you are trying to make good investment decisions, keep in mind that when the Fed talks, or now when the White House talks, it does move the market in a certain direction. It moves it fairly quick. The thing is, the Fed says one thing one day and Trump says another thing another day. And sometimes they coordinate, sometimes they don't. Sometimes they offset each other. And so you have to be pretty nimble and be watching that stuff constantly. If you're not, then hire somebody that does that. And also, you should only have money in the market that you can afford to lose or wait on or have a flat or even a bad year from time to time, because the market isn't going to be good every year forever. In the course of a few decades, I talked to somebody in their 50s this week, and they've got a potential probably twice as long as they worked. They're going to be retired living on the assets that they've saved. Now, they've done well. They've had some businesses that are able to cash out and will probably last a while. Wisely, the guy realizes that even though it's many millions of dollars, the market crash is going to affect his ability to make it 50 years. And the 4% rule probably won't play out. Is there a better way? And we're showing him a 6% rate of withdrawal with easy potential, very conservative estimate that he'll have a lot more money even when he passes in 30, 40, or 50 years than he starts with, and still has more income than he's been making. if you use the right products. Now, it doesn't mean we're going to invest all of that in the market. We can't, because you can't have all of it at risk and expect to live decades, because over the next 50 years, man, if we don't have 3 or 4 crashes of at least 30 to 50%, I'd be really surprised.
Once again, Jeff, excellent perspectives. The headlines will always change, but a well-designed retirement plan can help you stay focused on what really matters. So if you'd like a personalized retirement roadmap with Jeff Vogan at Premier Retirement, call 520-780-9059. You can make the call this weekend if you want. 520-780-9059 or visit premret.com to learn more. Coming up next, listener questions later. What happened in the markets during the second quarter of 2026, and what should investors do now when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
We really appreciate you making us part of your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson, also with an office up in Mesa. And if you've missed any part of the program today, remember, we're a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You're going to find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. We're also on the air 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then on Sundays at 11 a.m. And again, if you want to know more about our firm, it's premret.com, premret.com. All right, Jeff, time for listener questions. We've got 3 this week again. We'll kick it off with Bob in Vail. And Bob says, Jeff, I've been reading about principal-protected structured ETFs, and they sound pretty interesting. From what I understand, they may offer some downside protection while still allowing for some market growth. I'm wondering if they might make sense as part of the more liquid portion of my overall investment portfolio. What are your thoughts on these types of investments, and who are they best suited for, and what are the pros and cons that investors should understand before putting money into them?
Well, they are fine. They're an alternative for people that hate the word annuity. Principal protected annuities do similar things with principal protection. They might give, in addition to that, the reason we like the index annuity portion of principal protected assets is that they offer guaranteed income. With a structured ETF, they might have a cap of, let's say, 8 or 9% on the upside with no downside, or they might have a 15% upside with a 10% buffer for the downside. They also have what's called buffered ETFs that have some limited downside, but also limited upside. I like unlimited upside and just good management on the portion that you keep liquid. And I like the index annuities and things that guarantee income that are also principal protected. So we do use that same strategy. We just incorporate those assets that were built for principal protection, guarantees, retirement income, and the market has answered that, because as they see literally billions and billions and maybe even trillions now dollars maybe in a given year roll from the traditional ETFs, things with risk, or mutual funds into these assets that are principal protected, even though they have limited upside, they answered the call and said, hey, well, we can make an ETF that does that. So that's nice. If you want fee-based assets with some protection, that's fine. You can also protect it just by good diversification. There's some things that you can even do yourself and buy 4% short-term bond account and take the interest and just buy your own options on the market and have the same principal protection, because that asset's still going to basically be worth the same next year as it is now, and use that interest and do your own version of that if you're willing to actively trade. So you can do that on your own. Institutions are doing it now. They get a little bit of cut, especially with the options, because they're doing the same thing as insurance companies with principal protection are. They are putting your money in a safe place. That's the principal protection. They're taking the interest and they're betting it on the market in different ways to try to leverage the returns. Now, they do have a fee in addition to the fact that they probably make some spreads inside of those based on their option trading and stuff like that. So that's why there's limits to the upside. But while the limits to the upside is they only have about 4% to work with on your money. You can't make 20 or 30% on that. If the market goes up 20 or 30, you should be happy with 6 or 8, right? Instead of 4. If the market goes down, you're happy that you didn't lose money. So again, we use asset protection by strategizing between LIRPs, life insurance retirement plans with principal protection that provides tax-free income. IRAs, typically we put the indexed annuities. You have to take that money out anyway on a taxable basis. But we like levelizing the income from those on principal protection, giving you that income that will last for life. Now, the thing with the ETF portfolio is if you're using it for income, if you're using it just for safe, static, sit by the wayside money, maybe I'd rather have just a guarantee of 4 or 5% and be happy. But if you're okay with 0 and upside of maybe double your money and hopefully have more good years and bad years, and still have liquidity, then that's another way to play the liquid. I can get at that money anytime you need for an emergency. So I have no problem with it. We like a structured portfolio. We just use principal protection, generally speaking, in our other asset buckets. But I think everybody needs at least the more liquid portion of your overall investment portfolio. And again, when I go back to the IRAs, rather than have just kind of fluctuating gains in interest rates, means that your required minimum distributions down the road are going to be based on last year's account value. It's kind of hard to determine what your tax rate's going to be if you keep growing that asset, taking less than what you make out of it. Your RMDs are going to go higher and higher every year. You're going to get into a higher and higher tax bracket. What I like doing is, because people are in the go-go years when they first retire, is I'd rather levelize that income, get more income now, less income later, but know exactly where your tax bracket's going to be for life. And that's, again, why we like principal protection with income strategies combined with IRAs. And if you want liquidity outside of your IRAs and other income-producing accounts, I see no problem with the principal protected structured ETFs. The only thing I would say is a con is if you are using that type of a portfolio for income and you run out of income, you do run out of income. The index annuities with the income riders to continue income, even if you should run out of your principal on a principal protected asset. So you asked me for cons, that would probably be the only one.
Bob, we appreciate you listening to us in Vail. And again, if you want to further the conversation with Jeff, it's 520-780-9059, and you can make that call right now if you want. Okay, Jeff, next question is Lynn in Green Valley, and Lynn writes, Jeff, I'm getting ready to retire and roll my 401k into an IRA, but I'm a little nervous about the timing. The market seems to move from one day to the next, and I'm worried that if my money is out of the market during the transfer, I could miss a big rally, or on the other hand, the market could drop right after it's invested. What is the best way to minimize market risk during a 401k to IRA rollover, and how do you help clients navigate that transition?
Well, I think you have to decide if FOMO, the fear of missing out, is worth more than losing a big chunk of your assets. And you have a valid point. We typically would just roll a 401k over to an IRA. The positions stay the same. You don't have to liquidate it and stick it in cash and wait a week for it to roll over and then reinvest in an IRA. But at the same time, if it's in transition and the market crashes and you can't move those positions out, you have a bigger problem, I think, if you lost money. If you feel like you're in a position to be retired with a 401k that has X amount of dollars in it, I think you're at a point where you ought to be worried more about protecting the profits than worrying about missing out on a little bit more upside. Because if you've already had enough upside to retire, who cares if there's more upside? I'd care more about if you took a 20% whack in the market because it took a week and a half or 2 weeks to get that 401k in limbo, locked up, out, and then moved over. Most 401ks give you the option to just liquidate and then move the cash over. That's typically how we do it, so there's no worry about it. That way we know at least what we're starting with. We're going to reinvest that money anyway if we're managing it in the IRA. You probably have access to tons more stuff in an IRA than you have at your 401k anyway, so I'm sure you're going to want to reinvest. But at the same time, you're right. After you reinvest that IRA, it could drop after you move. It could drop while you move it. It could drop in the 408 between now and the time you decide to move it too. So you can always lose money. When are you going to take profits? You never get hurt taking profits. And if you're ready to retire, I'd be more into asset protection and make sure that you're okay with enough protected assets that will generate lifetime income that you don't have to worry about, so that you can take a chance on the upside of those with some of those assets, but with a small enough amount of those assets that if the market corrected 10 or 15 or 20 or even 50%, like it did a couple of times in the last couple of decades, that your world isn't changed or your retirement isn't basically flipped on its head and you have to kind of dig out of a big hole. I've talked about Norm, the story about Norm, who had $1 million going into retirement in the year 2000 and ended up, the market crashed while he's spending money and he never recovered. You don't want to be Norm. So if you haven't read the book, get the book. It's the first chapter, or you've probably listened to the show enough time to where you've heard that enough times. I don't want you to be the Norm. And I think you have more risk being like Norm and losing your money than you would by missing out on a week of upside, because a week of upside isn't going to be significant enough to make or break your retirement. But the market falls a lot harder than it goes up, and you have more risk during that transfer, I think, of losing money. So that's my take on it.
Lynn, we appreciate you listening to us in Green Valley. And again, the book is called Retirement: The Road Ahead. You can download it at our website, primret.com, or if you come in and sit down and have a conversation with Jeff, I'm sure that we have some hard copies here in the office. Again, we appreciate you listening to us. And if you want to further the conversation, it's 520-780-9059. Absolutely no cost and no obligation. Okay, Jeff, Richard is in Bear Mountain. Richard says, I'm in the process of converting some of my traditional IRA money into a Roth IRA over the next few years, and I have a question about how to invest each account. Would it make sense to keep most of the growth-oriented investments like stocks in the Roth IRA so that those gains can potentially grow tax-free, and hold more of my bonds and other conservative investments in my traditional IRA? Is that generally a smart tax strategy? Or are there other factors I should be considering when deciding which investments belong in which account?
Well, I think if you expect high growth to continue in the market, then put your Roth in growth assets, especially if you're not planning on ever touching the Roth. However, if you're planning on using the Roth for income, you shouldn't have high volatility stocks. I mean, if you move $1 million of IRA money, let's say you move half of it to a Roth over the next 5 years, 100,000 a year, you paid taxes on 500 grand. The last thing you want is to see that $500,000 be worth 250 and have you have to take some money out of it because you need a tax-free distribution because you don't want to go to a higher tax bracket, but then you lock in 50% loss on those assets. You already paid tax on all of it, and now you don't get a tax rebate when you take that money out. So I think there's two trains of thought. Some people say, I want kind of a moderate, I want principal protection with upside. If I can make 6 or 8% guaranteed on my Roth and never lose money because I pay tax on it, nothing wrong with that. If I just never want to lose money, I think when the market's high and overvalued like it is right now, due for a correction, I think you might want to consider kind of a lower risk investment to preserve what you pay taxes on. And honestly, what you leave in the regular IRA, if the market goes down and you take money out, essentially you've never paid taxes on it. So it's kind of like getting a tax deduction on your losses in the IRA. You don't want a unrealized tax deductible expense, which isn't tax deductible in a Roth crash. You want it on your IRA crash. So that's kind of a little food for thought. Again, if you, however, are going to dollar cost average into the Roth IRA over the next 10 years and just want to go aggressive or just want to just do indexing or just use an index fund, and you don't worry about the long haul because you're never going to need, you've got so much IRA money and so much pension money and so much Social Security that you can't even spend that much, then the chances of you using Roth IRA money are very slim to none. In that case, I would dollar cost average into the market, just let it grow over time and not worry about it, because I'm sure in 20 or 30 years, regardless of what the market does in the next 10, which could be bad, but I don't think the market's going to be horrible for 30 years. I mean, I could be wrong. I mean, the market in 1929 crashed and it took almost 30 years for it to get back to even. But during most of those 30 years, it was on an uptrend trying to recover. So you're still going to have the chance to make back that money and maybe add some more funds from the IRA over time to that Roth, especially if you wanted to dollar cost average in if the market did correct. There's two different trains of thought, depending on whether you're going to spend the money or might need the money, as opposed to whether you won't need the money. And it also depends on how fast you're going to make that conversion and how fast you want to pay those taxes and how much risk you want to take on losing that tax money for good if the market should correct and you need that Roth money.
Richard, we appreciate the question in Bear Mountain. And again, if you'd like to talk to Jeff, it's 520-780-9059. You can make the call right now if you want. Leave your name and number, and Shelley will get back to you, and she'll set up the conversation with Jeff. Absolutely no cost and no obligation. Jeff, before we get to our next segment here, I want to talk to our listeners for just a moment. If you'd like help building a retirement plan that's designed to help you navigate changing markets, inflation, interest rates, taxes, and retirement income, give the team here at Premier Retirement and Wealth Management a call today. 520-780-9059 for your no-cost, no-obligation Premier Retirement Roadmap. You can also learn more and schedule your complimentary retirement consultation with Premier Retirement Planning online at premret.com. That is PREMRET.com. Jeff, the second quarter certainly gave investors plenty to talk about. We saw the stock market reach some new highs. Artificial intelligence continued driving excitement. Yet many analysts are warning that there may be risks building beneath the surface. So let's review what happened during the second quarter and, more importantly, what retirees and pre-retirees should be doing now. Let's start with the big picture, Jeff. If you had to summarize the second quarter for listeners, what would you say?
Well, I mean, the headlines always are cheerleading the market. So if you just watch the headlines and only hear the good things, you probably think, oh my gosh, the market's screaming ahead. It's doing great. And it did. In the quarter, it probably had one of the best quarters it had in a long time, 15%. If you times that by 4, that's a 60% growth in the stock market, which I don't think there's ever been a single year that high. Well, it's not going to be that. Well, considering the market, that S&P was down 10% the first quarter. So again, it just basically made back the losses and then some, which is great. But I think the AI business still is really where all the excitement comes. Sometimes it's the semiconductors that are going to support that. Sometimes it's energy stocks. I mean, if you look at some of the energy stocks and the nuclear stocks and things that were supposed to generate energy last year were everything. And this year, some of them are down more than half of their value. Some of the rare earth metals and rare earth materials that go into all this, the battery technology and the energy technology, also went skyrocketing last year, and they're down more than half. So, I mean, if you stay invested in the wrong things, you're not having a good time. But if you're rotating into whatever's hot that week or that month, it looks like you're doing great. Now, the AI seems to be driving each aspect of it, or at least they're giving credit to it. But tech still remains a major force behind the rally. There's a lot of warning signs, though. I mean, the tech is so overvalued compared to historicals. It's also based on future earnings estimates, which are people's estimate in the business a little bit aggressive or a little bit far-fetched, given the fact that there's already competition coming into all kinds of aspects, from memory to the semiconductors to even the energy part of the business. So those companies aren't going to get all the earnings that they expect. The other thing we've seen is companies that buy a chip, let's say, for $1,000, they write it off over the next 8 years. That chip's not even going to last 3 years, but they're going to write it off over 8, which means they don't have to expense it this year. And it looks like because they sold their product for full value and book the entire thing as a gain or as income, yet they only write off a portion of what they purchased, it looks like they have far more earnings than they really do. I mean, there's going to become a day of reckoning. And when those assets that they're amortizing or they're writing off over 5 or 8 years only last 2 or 3 or 4, or maybe the 8-year lasts 5 if they can get that much out of it, they're still going to have these big write-offs come back in. They've got to clear the books eventually, and the book cooking will be done, and there's going to be kind of a day of reckoning and a day of awakening when the market's going to have to correct and come back to some sort of reality. But right now it's still based on hype numbers. It's based on fake accounting that isn't probably proper. But again, companies have done it for a long time. Typically when the truth comes out, like it did in '08 with the banking debacle of selling overvalued mortgages that weren't really A-rated, as if they were A-rated, all of a sudden the truth came known and the market crashed, and it became a big retirement stumbling block for many people for a decade or more in some cases. And some people had to work longer, and some people have a different retirement than they expected because half their money was gone in their 401ks, and they didn't have time to wait out the next 8 or 10 years before the market got back to even, before they needed to spend money. So again, that all could happen again. We have to see the warning signs. We have to see the charts and the graphs of things that have happened in the past and realize that those things happen again. Those things repeat. History always repeats. Nothing is ever different. The worst words, the most dangerous words in investing, according to John Templeton, who's been dead for several years, but very famous investors, the most dangerous words are, it's different this time. It's not different this time. It always ends up the same way. It just doesn't end up, the timing might be off. And I think the timing's been extended quite a bit by the money printing and by the creative way that companies are keeping their books right now in order to make that AI hype a reality with their stock prices, whereas it's not really a reality with the economic underpinnings of that company's true profits, true numbers, true success. So we'll see what happens. I'm obviously watching it on a day-to-day basis. I've got a significant amount of money in the market, and so do my clients. And so we want to make sure that we're not in the wrong place at the right time, holding on to the wrong sector of the market too long, taking profits when it makes sense to take profits, and being cautious. There's extreme high optimism. It's euphoric with the most investors, but most of those investors are called dumb money investors. They're Main Street investors. They're not the institutions. The institutions are very cautious, and I need to lean that way, because if you look at history, anytime everyone is convinced the markets can only go higher, that's usually the time that you need to be cautious and move on the sideway. It's not really predicting a crash. It's knowing that the crash is eventually going to happen. It's just being ready for it, being in a position to handle it when it comes, and not having all your money and all your income for the next few decades relying on what happens in the market and when it might happen. Again, nobody can time the market perfectly, but we do see signs that we have to know when it's time to be cautious and when it's time to be less cautious.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management. Our number 520-780-9059. We're talking about the first half of 2026 and in particular the last quarter. Jeff, at the beginning of the year, everyone seemed convinced that interest rates would be falling. Now the conversation has changed.
Well, I mean, the fact is, I think the war in Iran has stopped the whole narrative of interest rates can come down, because with inflation, you have to have higher interest rates in order to kind of combat that and not let it get too out of hand. If we say, oh, inflation is really only just a passive, this is just a transitory thing, like they did back in 2001 and 2, we'll find out that, oh, we didn't get a handle. Janet Yellen was saying, oh, gee, we didn't think it was for real. We just thought it was transitory. Well, shoot, you're the Fed and the Treasury Secretary. You should know better. We didn't know, but we're reacting now after inflation is up 22 or 23% in 6 months. So we have to get a handle and get ahead of that. And I think, we've learned our lessons, and we have to be cautious about lowering interest rates. And I think with the inflationary pressures right now, besides money printing, crazy investing, the amount of wealth that's been built in the stock market that's, in my mind, kind of, it's not ill-gotten gains. It's just kind of like fake. It's not like fundamentally sound. But hey, if you bought and sold your stock and you got cash out and you bought a big boat or a big house, you still own it. So good for you. The economy is booming in that sense. And the fact that people have money, they can spread it around and buy things, creates better economy for everything. So I'm not opposed to an overvalued, robust market, or people getting rich, or millionaires being created out of thin air just because they jump in a Micron or Intel or some stock at the right time. I'm all for that, but I'm also not for betting your retirement dollars and your paychecks on that kind of money. That's really more speculative than fundamentally driven, and that's just where it's at now.
Jeff, gold and silver had tremendous rallies, but recently they have pulled back. Should investors be worried about this at all?
Well, if they're investing and expecting gold to continue to go to $10,000 an ounce like they were speculating before, I think that was just hype in order for the institutions and those big buyers, central banks, et cetera, to get out of 5,000. Well, now it's not 5,000 anymore. It's in the fours. So that's gold. Silver was up to over $100 an ounce, and now it's not even 70. So silver could go down another 50% and still be higher than it was a year and a half ago. So you'd still be up, but is it time to take profits? My opinion is you never get hurt taking profits. And it looks like there's some softness in the gold and silver market. So if you've made a ton of money on gold and silver and you're planning on using that for the future or for spending, it doesn't hurt you to take profits and set that aside into something that'll generate some cash flow, because gold doesn't. It's really just a speculative investment, in spite of the people on TV calling it an inflation hedge and all this stuff. If you look at what's really happened with inflation over the years and gold prices, they are not correlated. So everything they say on TV as far as the hype of why you should buy stock, there's really no correlation or no rhyme or reason other than maybe one period of time that they could actually put a chart next to it and say, look what happened here. But it doesn't happen over the long haul. If you look at gold, when it was $5,000 an ounce, it looked like if you held it for the last 10 years, it turned out to be a good investment. But if you held it since 1989, when it was $900 an ounce and it's finally now 50 in 40 years, that's really not that good of an investment. I mean, you could have done better on CDs over that same period of time. However, if you bought gold at $30 an ounce in the 60s or 70s, that ends up looking like a much better investment. If you compare gold to S&P and other investments, typically over time, most periods of time, they don't beat the market. But hey, we took advantage of it last year and made a really good rate of return on the portfolio that leaned heavy into gold and silver. But we haven't been in it since March. So we're glad. We took a beating in February and March, unfortunately, and didn't cap out at the top, but still we made a good hefty profit. So you never get hurt taking profits. If gold gets down far enough and starts reversing and the trend starts up again, I'll jump on that bandwagon again, because I think gold and silver is still very popular from the standpoint of central banks and institutions wanting to own a piece of it. I think as precious metals, they still have an industrial application as well. Silver probably more than gold, but I don't know how much gold jewelry you really need and how much gold you need in a safe to float your boat, so to speak. And I don't know how much central banks really need to have billions and billions or trillions of dollars worth of gold as a backup, unless somehow we're going to go back on a gold standard, which I think we're probably more leaning into a digital currency standard than a gold standard, because it's easier to track, easier to manipulate, easier to tax, and easier to follow and track us. Gold doesn't accomplish the government's true goals to control its subjects. So I have a hard time believing gold will ever become the monetary standard, or that the dollar is going to be based on, or anybody's currency is for that matter. So again, I think it's an investment you can take advantage of. I think it's worth watching. I prefer buying ETFs, other than the fact that I have a pretty decent amount, probably more than most, but I've got assets sitting in my safe. I do have hard assets. I don't plan to sell those or use them even as a hedge. It's just another asset that I can park money in. But if you think you need that for cash, or you might need cash flow from it, then I would consider doing what we do in our managed portfolios, and that is using the ETFs, the exchange traded funds, that track the gold and silver price. Gold and silver are going up, or if the mining companies that support those gold and silver prices or support the industry are going up, then let's get on the wagon and make some money. If they're going down, then we don't want to be in them.
Jeff, as we begin the second half of the year, what's your advice for investors?
Just always be cautious. Never be afraid of taking profits. Make sure your income is guaranteed, not speculative. Don't risk your retirement on anything you can't control, and you can't control the stock market. Even though it trends up over time, it doesn't trend up from month to month or year to year basis when you need your money. So if you're in an income phase, make sure you have income. Nobody should have to worry and wake up worried about the retirement or their ability to stay retired every day of the retirement. I guarantee that's going to shorten your retirement, maybe by a decade or more, just from health issues. So if you can retire in your own terms, have peace of mind, confidence that you're not going to run out of money, and only invest money in the market, which could be very frustrating and very volatile and cause a lot of gut ache. Don't have enough money in there that you get sick over it if the market would correct. So again, you have to reassess your risk tolerance, reassess where you are in your retirement life, look at your plan. If you don't have one, get one, and make sure that the plan gives you the confidence that you can have all your bills paid for the near term and even the longer term for as long as you might live and long as your loved ones might live. Make sure that your goals are intact. If they're not, figure out a way to make them, or maybe adjust your expectations a little. Sometimes we have to do that. But most of the time, if you structure your assets correctly and don't take too much risk, you can actually build in enough security that you can take more risk or be a little bit more aggressive with those investments that you do have in the market if you know everything else is taken care of. So I would say if you don't have a plan, get one. If you haven't reviewed your plan in a while, review your plan, consider your risk tolerance, understand that the market is super high valued, super volatile, and at a place where profit taking is probably wiser thing to do than invest new money in the market at these levels.
Great advice as always, Jeff. Once again, if you'd like help building your retirement plan that's designed to help you navigate the changing markets, inflation, interest rates, taxes, and retirement income, give the team here at Premier Retirement Planning and Wealth Management a call today. 520-780-9059 is our number. You can make that call right now if you want. Leave your name and number. Shelley will call you back and set up a time for you to talk with Jeff. And again, it is just a casual conversation. 520-780-9059. We're also online at premret.com, premret.com. Well, Jeff, we're out of time for this week. Once again, I want to thank you for your time, but as I do every week, I want to thank our great listeners here in the Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.